Good morning, everyone. Welcome to today's presentation. I'm excited to take you through an interesting comparison between the India and USA income tax systems. The title of our presentation is India vs. USA Income Tax System, presented by S.K. Vijay. Over the next few minutes, we'll explore the key differences, similarities, and some unique aspects of each country's tax structure. So, let's get started and gain some valuable insights into how these two major economies handle income taxation. Now, let's look at the residency rules in India. In India, your tax liability is primarily based on your stay in the country. If you're an Indian resident, you are taxed on your global income. But there's more nuance. If you've been in India for a certain period, you might be classified as a resident, RNOR, or non-resident. Even if you're an Indian citizen living abroad, you could still be taxed in India if your stay criteria are met. Switching over to the USA, the system is quite different. Here, taxation is primarily citizenship-based. That means, regardless of where you live, if you're a U.S. citizen or a green card holder, you're taxed on your worldwide income. This distinction is fundamental because it affects how individuals plan their finances and compliance strategies. Understanding these rules is crucial as we compare the two systems, especially when considering cross-border income and planning. It highlights how residency and citizenship criteria shape tax obligations in both countries, which is a key theme throughout this presentation. Let's take a closer look at the tax structures in India and the USA. Starting with India, the country uses a progressive slab system, which means that as your income increases, the tax rate applied also increases. What's interesting here is that India has an old regime and a new regime, offering taxpayers some flexibility in choosing their tax structure based on their financial planning. Moving to the USA, the system is also progressive, but it expands further with multiple brackets. Plus, in addition to federal taxes, many states have their own income taxes, which adds another layer of complexity. This layered approach means taxpayers need to be mindful of both federal and state obligations. Connecting this to our overall theme, understanding these different structures helps us see how tax policies shape individual financial planning and government revenue strategies in both countries, highlighting the importance of a well-designed tax system in economic development. Let's take a closer look at the regime choice in these two countries. Starting with India, it has a unique dual system. Essentially, India operates with an old regime and a new regime side by side. This means that different sets of rules or tax structures might apply depending on the context or the type of income. It's a bit more complex, but it allows for flexibility in managing taxation. In contrast, the United States follows a single federal system. There's only one overarching federal income tax system that applies uniformly across the country. This simplicity in structure makes it easier to administer and understand, especially for taxpayers. When we compare India and the USA in terms of their income tax systems, we see these fundamental differences in their regime choices. India's dual approach offers a layered and adaptable framework, while the US's single federal system emphasizes consistency and straightforwardness. This comparison really highlights how regime choice shapes the overall approach to income taxation in each country, fitting into the broader theme of how different nations design their tax systems to meet their unique needs. Let's take a closer look at deductions and exemptions in the income tax systems of India and the USA. In India, there's a heavy reliance on various deductions like Section 80C, which includes investments in provident funds, PPF, and others. Then there's Section 80D for health insurance premiums, HRA or house, rent allowance, and LTA or leave travel allowance. These deductions significantly reduce taxable income and encourage savings and investments. In contrast, the USA offers a more straightforward approach with a standard deduction option or itemized deductions. When opting for itemized deductions, taxpayers can claim expenses like mortgage interest, medical expenses, and charitable contributions. This system provides flexibility, but also requires more documentation. Overall, you can see that India's system emphasizes specific deductions that promote savings and social welfare, while the USA's system offers choice between standard and itemized deductions, allowing taxpayers to tailor their approach based on their expenses. Both systems aim to reduce tax liability, but do so through different mechanisms aligned with their respective fiscal policies and social priorities. Now, let's look at how withholding and advance tax work in India and the USA. In India, the system primarily relies on tax deducted at source, or TDS, which is deducted directly from salaries, interest, and other payments. Additionally, for those with a tax liability exceeding 10,000 rupees, advance tax payments are mandatory. This means taxpayers need to estimate their income and pay taxes in installments throughout the year. In contrast, the USA uses a different approach. Employers typically withhold taxes from employees' paychecks automatically, similar to India's TDS. But for contractors or self-employed individuals, they are responsible for paying estimated taxes quarterly. This ensures that taxes are paid in smaller, manageable installments rather than a lump sum at the end of the year. Connecting this to our broader theme, both systems aim to collect taxes efficiently and ensure compliance, but they differ in their methods and timing. India emphasizes direct withholding and periodic advance payments, while the USA combines employer withholding with quarterly estimated payments for non-wage earners. Let's take a closer look at how capital gains are treated in India and the USA. In India, the holding periods for assets are asset-specific. For example, if you hold equities for more than 12 months, it qualifies as a long-term capital gain, whereas for real estate, the threshold is 24 months. This means the duration you hold an asset before selling it significantly impacts the tax rate. In contrast, the USA adopts a more uniform approach. They categorize capital gains into short-term and long-term based on a fixed time period, less than 1 year for short-term capital gains and 1 year or more for long-term. This simplifies the classification, but also emphasizes the importance of holding periods in tax planning. Connecting this to our overall theme, understanding these differences helps us see how tax systems shape investment behavior in each country. Whether the rules are asset-specific, like in India, or more uniform, like in the USA, they influence investor decisions and financial strategies. Let's talk about dividends now. In India, dividends are taxed at the individual's slab rate, which means the tax rate depends on your total income level. It's important to note that the dividend distribution tax, or DDT, has been abolished here, so now the tax is directly on the recipient. Now, shifting to the USA, dividends are classified into different categories. Qualified dividends, which are typically from American companies or certain foreign companies, are taxed at lower rates. These rates can range from 0 up to 20%, depending on your income bracket. This distinction is quite significant because it affects how investors are taxed in each country. It highlights how India and the USA approach the taxation of investment income differently, reflecting their broader income tax systems. Understanding these differences is key, especially as we compare the overall tax environments in these two countries. It shows how the tax policies impact investor returns and the attractiveness of each market. Let's talk about audit and compliance in India and the USA. In India, there's a clear mandate for tax audits when your turnover exceeds certain limits, specifically under Section 44 OB. This means if your business crosses those thresholds, you're required to get a mandatory tax audit done. Additionally, India offers presumptive taxation schemes like 44AD, 44ADA, and 44I, which simplify compliance for small taxpayers by allowing them to pay taxes based on presumptive income instead of detailed accounts. Now, contrasting this with the USA, there's no mandatory audit threshold for most taxpayers. Instead, the IRS conducts audits based on risk assessments. They select cases that might have discrepancies or red flags rather than applying a blanket requirement. So overall, India's system is more rule-based and threshold-driven, while the U.S. system relies more on risk evaluation for audits. This difference reflects the broader approaches each country takes toward tax compliance and enforcement. Now, let's take a look at the compliance and filing requirements in India and the USA. In India, the system is quite detailed, with multiple ITR forms ranging from ITR 1 to ITR 7, each tailored for different taxpayer categories and income sources. Additionally, there's a mandatory tax audit requirement that kicks in when your turnover exceeds certain limits. This means that larger businesses or those with higher turnover need to undergo a more rigorous audit process, which adds to the compliance complexity. In contrast, the USA simplifies this process with a single main form, the Form 1040, complemented by various schedules depending on the taxpayer's specific income types and deductions. This unified approach makes filing more straightforward for individual taxpayers, although the schedules can still be quite detailed for complex financial situations. Overall, these differences highlight how each country approaches tax compliance, India with its multiple forms and audit requirements, and the USA with a more streamlined, single-form system. Understanding these distinctions is crucial as we compare their income tax systems and their impact on taxpayers. Let's talk about the return filing due dates. In India, the deadline is generally the 31st of July. That's pretty straightforward and consistent across the country. Now, shifting our focus to the USA, the situation is a bit more varied because each state can have different due dates. Most states in the US have their tax filing deadline on April 15th, which is the same across many regions. However, there are exceptions. For example, one state has its deadline on April 21st, which is slightly later. Then, a few states have their due date on April 30th, and another set of states even extends it to May 1st. This variation highlights one of the key differences between the Indian and US tax systems. India tends to have a uniform deadline, whereas in the US, you need to be mindful of your specific state's deadline. It's an important point because it affects planning and compliance. Overall, understanding these deadlines helps us appreciate the differences in how tax systems are organized and enforced in each country, which ties into the bigger picture of how income tax systems are structured globally. Now, let's take a look at some of the extra levies that come into play in the Indian and US income tax systems. In India, there are additional charges like the health and education cess, which is currently set at 4%. This means that on top of the regular income tax, taxpayers contribute this cess to fund health and educational initiatives. Additionally, for high net worth individuals, or HNIs, there is a surcharge that applies, increasing their overall tax liability. On the other hand, in the United States, the focus is on payroll taxes, primarily for Social Security and Medicare. These taxes are deducted from wages and are essential for funding social safety nets like retirement benefits and health care for seniors. So, while India emphasizes extra levies like cess and surcharge to address specific needs, the U.S. relies more on payroll taxes to sustain its social programs. Understanding these differences helps us see how each country structures its approach to funding public services through taxation. Let's take a look at the key differences between the income tax systems in India and the USA. In India, income tax is a central subject, meaning the central government is responsible for collecting and managing all income tax. There's no separate state-level income tax, so the entire system is unified under the central authority. In contrast, the United States has a more complex setup. The country operates on a federal system, which means the federal government collects income taxes nationwide, but individual states also have their own tax systems. These state taxes can vary significantly from one state to another, leading to a diverse and often more complicated landscape for taxpayers. Understanding these differences is crucial because it influences how tax policies are designed and implemented, and it also impacts taxpayers' compliance and planning strategies across both countries. This contrast between a centralized system in India and a dual system in the USA highlights the diversity in governance and tax administration globally, which ties into our overall theme of exploring different tax frameworks worldwide. Let's take a moment to compare the key differences between the India and USA income tax systems. In India, the system is quite centralized, meaning most tax regulations and procedures are managed at the national level. It's heavily deduction-driven, so taxpayers often rely on various deductions to reduce their taxable income. Additionally, the system is very compliance-driven, requiring strict adherence to rules and regulations. On the other hand, the USA has a dual-layer system, which includes federal and state taxes. This adds complexity but also allows for more localized tax policies. The American system is citizenship-based, meaning citizens are taxed regardless of where they live, and it tends to be deduction-light, so fewer deductions are available compared to India. Instead, it relies heavily on payroll taxes, which fund social programs like Social Security and Medicare. Understanding these differences helps us see how each system reflects its country's approach to governance and social welfare. While India's system emphasizes central control and deductions, the USA's system balances federal and state contributions with a focus on payroll taxes. This comparison underscores the broader themes of centralized versus decentralized governance and the different ways countries structure their tax policies. Let's look at the key takeaways from the comparison between the Indian and U.S. income tax systems. First, if you value flexibility and tax-saving options, the Indian system offers more ways to reduce your tax liability. This is through various deductions and investment-linked benefits that can really help optimize your tax planning. On the other hand, if simplicity and consistency are more important to you, the U.S. system generally tends to be better. It relies less on complex deductions and exemptions, making it easier to understand and manage. So, depending on your priorities, whether it's maximizing savings or keeping things straightforward, each system has its own advantages. And understanding these differences can help you make informed decisions about your financial planning across these countries. Now, before we move forward, I want to highlight an important disclaimer. The contents of this document are meant solely for educational and informational purposes. They are not intended to serve as professional advice or formal recommendations. This presentation is designed to give you a general understanding and guidance, but we cannot be held responsible for any losses that might arise if someone acts or refrains from acting based on this material. So, I strongly encourage everyone to seek professional advice tailored to your specific circumstances before making any decisions related to tax matters. With that in mind, let's now turn our attention to comparing the India and USA income tax systems, which is the core focus of this slide. Believe in yourself, and you will be unstoppable. Today, I want to emphasize how self-belief is a powerful force that can propel us beyond perceived limitations. When we truly trust in our abilities, challenges become opportunities to grow, rather than obstacles. This mindset is essential, especially when navigating complex systems like the income tax frameworks of India and the USA. By believing in your capacity to understand and adapt, you can master these systems and turn them to your advantage. Remember, confidence fuels perseverance, which in turn leads to success. So always hold on to that belief in yourself, because with it, nothing is truly unreachable. And that's how you become unstoppable in your journey, whether it's understanding tax systems or achieving any goal. Thank you so much for your time and attention today. I truly appreciate your interest in our work. I'd like to take this opportunity to thank everyone who made this presentation possible. Presented by KnowledgeAlia, and I am SK Vijay, the founder. If you have any questions or want to connect further, please feel free to reach out to me via email at vijx0201@gmail.com. And don't forget, you can also follow KnowledgeAlia on LinkedIn to stay updated with our latest news and insights. Once again, thank you all for being here and for your support. I look forward to connecting with you soon.